Welcome to Stock Talk with Ego Criticos. Today we're going to be taking a look at Kohl's stock, ticker KSS, and this is a company that I bought about a month or two ago, and we're going to find out why I think this is an attractive investment. So the first thing we're going to look at from my checklist is going to be the revenue and net income, and what we're going to see that it's not the best chart here, right? It's pretty much been flat since about 2010, 2011. It's been at about $18 billion or so since then. So they haven't had a huge jump in revenue, but it's pretty much been flat. It also hasn't decreased by too much either. So it's not horrible. Same thing with net income. The net income is probably a little bit worse actually, because we have 2 years of negative net income in the last 3 years. And then since 2012, when it hit $1.1 billion in net income, that number has come down. And now, we see anywhere from 500 million to right under $1 billion of net income, but it's definitely not trending in a good direction. If we come back to the stock chart here, we're going to see that the stock is almost at a 5-year low. During the pandemic, it went all the way down to $11, which is pretty bad, probably because people thought it might go out of business. But now with it being at $23, my main bullish thesis on this company is built around their equity that the company has, as well as the dividend that this stock pays, because the stock pays a 8.5% dividend at the moment, and the market cap is only $2.5 billion. So you can see I bought 75 shares here at $24, and I think I bought it undervalued, and I'm definitely going to appreciate getting this 8.5% dividend along the way. So the first two things on my checklist are going to get a no. The other things I want to show you guys here is going to be pretty much consumers' preferences for retail stores. And you're going to see Target and Walmart are number 1 and number 2 with 20% market share, I guess you could say, for each. And then we have Macy's at 8%, and then Kohl's is in 4th place with 5%. So it's actually a good sign that they're above Sears, TJ Maxx, Nordstrom, and all these other companies. Then we pull up another article here. We're going to see the most popular department stores. We have, again, Target, this time Costco, Walmart, Sam's Club, and then we have Kohl's, which, again, that's 5th place is pretty good. It's ranking higher than Dollar Tree, Macy's, JCPenney, TJ Maxx, Big Lots, all these other companies. So that's a pretty good sign. I think people really like the Kohl's Cash thing, and the other thing this company's doing right is that they have those Amazon lockers into their locations as well. And I read that to kind of combat what Target is doing with Ulta, because Target and Ulta partner to have Ulta makeup products in the store, Kohl's is doing the same thing with Sephora. So Kohl's is keeping up in a lot of ways, and they are making some moves out there that are setting them apart from some of their competition. And if we're looking at the next one, we're going to be looking at the price to earnings ratio. This is where it gets good, again, because if we're looking at the last decade or so, this company trades at about a 9 price to earnings on average. In the last couple of years, ever since the pandemic, it's been a little bit lower. You can see here it's been, it was at like a 10, a 7, 9, 6, and then now they reported negative net income, so it's 0. But we're really trading at about, if you're on a forward basis, they're expected to do $3 of EPS, not this year, but next year. So we're looking at, and it normally trades at a 9. So 9 times 3 is 27. That means by next year, this stock should be at least $27 a share would be the fair price, I would say. And that's, you get that. That may not be huge appreciation. Maybe that's only 20% or so, but you are getting an 8.5% dividend on top of that, which is very nice as well. So that's where I see the stock price going over the next 12 months. For number 4, I put they're not innovative. They don't have a moat, even though I just said they have things like Kohl's Cash, the Amazon locker, and the Sephora partnership. That is somewhat of a moat, I would say. It's not a huge one. It's not, other companies can replicate that pretty easily, I would think. A growing industry, yes. I saw that one report said that retail is only going to grow by 2 or 3%. Another said 10. I think worldwide it said 10%, but I think in the United States, maybe it's only 2 or 3%, but it's still a growing industry. So as long as Kohl's can keep up with that, I don't expect them to grow too much, but 2 or 3% a year is all they need to do, really. Respectable return on invested capital. That we are going to see that they did 2% last year. Once again, they had a bad year, 2023 and 2021. But prior to that, they're doing 14%, 9%, 14, 11, 13, all these numbers. And then back in the day, they were doing, as high as 19 to 25%, but anywhere around this 10 to 15% mark is good enough. That's not bad at all. Growing equity, this is also a concern for this company. So this company is not in the best financial position. I'm just kind of playing this stock based off of the valuation. So equity, 5.4 billion 3 years ago. Today, 3.7. So it's trending downward. That's not good. Their assets have stayed the same. Meanwhile, their liabilities have gone up by $1.5 billion. So that part's not good. That's going to get a no. Then we're looking at the equity. Is it over 15% of the market cap? Yes. This is where it gets, this is my reason for investing. So we're looking at $3.7 billion of equity. Remember, I said the market cap is $2.5 billion, right? So if you look at it like that, that's $1.1 billion under book value you're getting this at. But I do not like to count the goodwill because that's intangible, it's not liquid, and that can change rapidly. So goodwill is worth something, okay? But it could, it doesn't mean it doesn't mean 1.3 billion is the number that it has to be. That can be 500 million or 300 million or something. So we're just going to count it as zero just to be extra safe and leave some room there for the valuation. And if we do that, what we're going to find, interestingly enough, is that when you minus that 1.3, what number do we get? We get right about a 2.5. We get, let's see, 3.7 minus 1.3 is going to be 2.4 billion, 2.5 billion. And that's exactly where the market cap's at. So that's exactly what we're trading at. So that means even if they went out of business and sold everything, the stock would be worth at least $23 a share. And that's not even, and that means that's not counting the 8.5% dividend either. So that's why I feel pretty comfortable doing this. I feel pretty comfortable being in this stock at this price. And it doesn't mean I'm going to hold it forever, but it means I'm expecting to make, I don't know, maybe 20% on this or something like that. How I said, $27 a share by next year should be a realistic. No, I mean, it could go a lot higher. It could go to $35, but $27 a share, if they're doing $3 of EPS, is about fair. That's about a fair valuation. So that's a big reason of why I'm investing. Share count decrease. They also have been doing a pretty nice job of buying back shares. You can see all the way from 2006, it's been steadily decreasing, and they're buying back, nearly 3% of shares per year. So that's pretty good. Are the assets anywhere near double the liabilities? No. The profit margin is not over 10%. It's actually, let's see what we got here. It's only, so once again, we had 2 negative years, but we have a 5%, 3%, 4%. So not great margins, but it is what it is. Cash and receivables, no, they are not over. Remember, they're normally doing it's hard to see what their average annual income is because it could be as high as $1 billion or it could be, 400 million. And we saw it was negative in 2 years during the last 3 years. So, but they only have 300 million in cash and receivables. So not the greatest balance sheet again. Healthy dividend. This one is very debatable as well because they don't have steady cash flows and they're not always positive. So what we're going to see is net income is, 2020, nearly 700 million, then negative 160 million, then positive 900 million, and then negative 19 million. But if we're looking at how much they're spending on the dividend, we're going to see it's weird because before the pandemic, they were paying out $400 million and they cut that down by 75%, started raising it, and now we're about halfway there, a little bit more than half of what it used to be. And remember their net income was right around 700 all the way up to $1 billion. So really, if they're doing the right numbers that they should be around 700 million to 900 million, then this dividend of, where is it? This dividend of $200 million, even if they wanted to go to $300 million, so they could raise this dividend, it's not a problem. So I think they have some leverage there. Even if they cut this dividend in half, right? If they cut this dividend in half, we're still looking at almost a 4% dividend, let's say. And that means they could be saving $200 million. Yeah, they could be saving $100 to $200 million in 1 year that they could reinvest back into the business, right? And that's going to add to that equity stake. So that's why I feel pretty comfortable. Even if Kohl's did go under, which I don't know if they are. I mean, they could end up like a Carson's or a Sears. But another way to look at that is like Amazon has been around for a while. E-commerce has been around for a while. So it's possible that, you know, more of these retail brick and mortar stores go under, but it seems like Kohl's has a pretty strong, loyal customer base, better than, you know, some others out there like Big Lots or even like the dollar stores or some of these other competitors. And so that could be something that keeps Kohl's alive. And the company is over 20 years old. So all in all, we're looking at a score out of 7 out of 14. Remember, it's not the strongest company. They're not growing. They're not really growing their revenue or net income. Their equity is shrinking because they're getting more and more liabilities without growing their assets. They got low margins, and that's it. They don't have a strong balance sheet, and they're not growing their revenue or net income. So what's their options? Their options are either to get bought out, which is a possibility. Their option is to go under, go bankrupt, and sell everything. And then we would probably cash out at, you know, right around this $23 a share mark, I would think. Or their option is to lower their dividends, stop paying out $240 million a year in dividends, and maybe cut it down to half of that and pay a 4% dividend. And then they got more money to invest. So they have some options here to keep going. And that's why I feel like, I know it's not the strongest company, but I'm buying it at a very cheap valuation. There's not much risk here that I see. So those are my thoughts on Kohl's stock. Thank you for watching, and I will see you guys in the next video.